To my fellow veterans, what is the VA IRRRL? That's IRRRL, Interest Rate Reduction Refinancing Loan. Gotta love the military and all the acronyms that they come up with, that it even carries over to the mortgage business, because that's a ridiculous acronym for just saying we're gonna refinance your rate and give you a lower rate. But hey, it is what it is. It's the IRRRL, IRRRL. What do you need to do to qualify for a VA IRRRL? First of all, you gotta drop your rate by at least 0.5%. Not in all states is it worth refinancing at only a 0.5% reduction. For example, Florida has higher closing costs than most states, so you want to drop by at least 1% in Florida. If you're talking to a company that is telling you that's not the case, then run. Sometimes in other states like Texas, where costs are lower, California, then 0.5% makes sense. You also want to compare what your closing costs are versus your drop-in rate. Drop-in rate alone is not enough to figure out if it's worth it, especially since you have a lot of sneaky companies out there, these big call centers. Think of these companies that have the word veteran in their name, or they have military branch in their name, or like a spaceship in their name. A lot of these companies will tell you, hey, we're dropping your rate by 2%, but they will not tell you verbally over the phone that they're charging you discount points, origination, extra fees, whatever you want to call it. There's 20 different names for what points are. It's an extra cost added to your loan, not your normal closing costs. Those are in place to buy down your rate. So they might be telling you, hey, this veteran guy over there, Phil Stevenson, mortgage nerd, he's only giving you a 1% drop in your rate. We're going to give you 2%. They're not telling you they're charging you 2% more in closing costs than I am. So what's the point in paying so much money in closing costs to drop your rate by a couple percent? I have a rule. It's kind of a 1-to-1 rule. It's not set in stone. It's something I guide myself by. If you drop your rate by 1%, you want to have about 1% in costs. If you're 1.25% in cost, maybe it still makes sense. Then you can see if buying your rate down a little bit, paying a 0.5% to get a 0.5% lower in rate. So now you're 1.5 to 1.5. That's still my 1-to-1 ratio, right? A lot of these companies, they don't tell you anything like that. They'll have you pay 3% in closing costs and drop your rate 1.5 or 2%. So you're really off by 1-to-1 rule in that case. Now, the VA is the only mortgage product that has a rule that states what you need to have to lower your interest rate. Not only is it the 0.5% I mentioned earlier, but they also have a recoupment scenario, a recoupment calculation. So what they mean is, how long does it take for you to recoup costs based on your savings, for you to surpass your closing costs? So if, going back to my example, if it's a 1-to-1, if your costs are 1% and your rate drop is 1%, it takes you a year to surpass your closing costs, right? Well, the VA says up to 36 months. Now, they also don't use the interest rate example I gave you. They use your payment. So if your payment dropped by $300 a month and there's 12 months out of the year, then for your savings to surpass your costs, it takes 12 months. 300 times 12 is 3,600, right? So in a year, your savings has surpassed your costs. If your drop in payment is $300, then $9,900 in cost is recouped in 3 years, and that's good. I'm not a big fan of that. I don't know if that's worth it, especially in a market like this, where in the next year or two, you could see mortgage rates much lower and you'd be refinancing again anyway. So I'm a little more conservative than the VA, even though, again, the VA is the only one that has a rule. Conventional and FHA do not have a rule as far as how much you need to drop your rate and what your recoupment is. So the VA is good in that sense that they have a rule for it. I don't quite follow it. Something else the VA has that conventional and FHA do not have, aside from there not being mortgage insurance premium, they also don't care if your balance rises. So you could just purchase your house with 100% financing, meaning you put $0 down, and now you're adding your closing costs to that. It could be 7 months after your first payment. That's when you qualify. So they're adding closing costs to that. So now you owe more than 100% of your value. They don't care. They don't get an appraisal. They don't look at your income. They don't look at your employment. As long as you have been making your payment on time for the last 12 months, or if you've only made 7 payments, as long as you made every payment on time, you can qualify. Of course, you have to have a good credit score to give you a good rate. So don't think you can come in with a low credit score and get a VA IRRRL and actually make a difference. Now, if your credit was very low, and so you got a super high rate, and now your credit's a little better, maybe it makes sense. We can look at all that. Either way, that's another aspect of the VA IRRRL. That makes it a very smooth process, very fast process. Typically 2 weeks from beginning to end. Could be faster sometimes, could take longer because maybe you want to do the magical skip 2 payments. Well, guess what? There is no magic. You're not skipping anything. You're still paying your interest. A lot of people won't tell you this, just like they won't tell you about the points when they're sending you over their numbers. They hope you just sign it and move forward. The same way they make it seem magical that you're skipping 2 payments. You're not skipping anything. You're just not taking the money out of your pocket. Remember when I said your closing costs could be added to your loan amount? Well, those 2 payments are added to your loan amount, not the principal, but your interest. 2 months of interest or a month and a half, whatever it ends up being, is going to be added to your loan amount. And it's just dependent on when we close in the month. So right now we're mid-May. If you want to skip your June 1st and July 1st payments, we will close you towards the end of May so that the loan funds and pays out at the beginning of June. Every refinance has a 3-day rescission period or right to cancel period. So that's how we'll structure it and give you the magical 2 skipped payments. Again, that adds to your loan amount, so you'll owe more than your value. You can't do that in conventional or FHA. That's a great aspect of the VA IRRRL, the VA refinance. It's not for pulling money out. You can only get up to $500 at closing. The point of this is to lower your interest rate, skip a couple payments, and that's it. I live in the Florida Keys. I just got out of the Florida Keys. I'm heading to the VA outpatient clinic in Homestead. I'm no longer on this 1-lane stretch, so now it's a little dangerous for me filming this, so I'm done. I hope you got some value out of this. Please like, share, subscribe. See you next time. Mortgage nerd out, veteran mortgage nerd, fellow veteran to you all. 100% disabled, just like some of you. Happy to help you with anything mortgage related. Phil Stevenson, thank you.